Mohamed, let's start right there with this move in the equity market. 5% from the highs. I don't know if the door's creaking or not, Mohamed. Is the window starting to close just a little bit for the Fed to do something here?
I wouldn't say the window is closing a little bit. I would say the window is closing a lot when it comes to an orderly taper. Look, they can taper any time, but if they don't get moving quickly, then they are going to disrupt the bond market in a much bigger way than they would otherwise. And the equity market is going to have to worry about that. So they still have a window for an orderly taper, but it's getting awfully small, John.
Your piece this morning in Bloomberg Opinion, Mohamed, let me read out some of the highlights. Demand is not the economy's problem, supply is. Policymakers and central bankers are stuck in a mindset from the last crisis and need to alter their thinking. What does that mean for policy, Mohamed?
So first and foremost, it means look at the supply side and do something about it. It is incredible to see a problem that has persisted and getting worse not being addressed in any meaningful way by policies at the national level and at policies at the multilateral level. At the national level, we know what the problem is. It's not design. It is Congress not being able to get things through. But we've seen almost nothing at the global level, John, and this is a global problem. On the other side, demand stays robust. We saw it again today in the spending and income numbers. We don't have a demand issue, we have a supply issue, and the mindset has to move decisively away from thinking that our problem is deficient aggregate demand, as it was after the global financial crisis, to what it is today, which is disruptive supplies.
So what do you think a reduction in central bank accommodation will actually achieve?
Less inflation, less elevated asset prices that cannot be sustained by the economy, and they will reduce the risk, importantly, of the Fed having to slam on the brakes. No one wants the Fed slamming on the brakes. No one wants the Fed to accelerate taper and have to accelerate the rate increases, because then the real economy gets sacrificed and corporate earnings get sacrificed and the poor get sacrificed. So it's really important for the Fed to realize that if you look at the two-sided distributions of potential outcomes, right now the risk of being too late, in my opinion, is higher than the risk of being too early.
Mohamed, I want to pick up on that risk in just a moment. The pushback that we often get with these conversations is that if the Fed's role here doesn't do anything for inflation, because this is a supply-side story, why would the removal of accommodation achieve anything on the inflation side of things? What's the response to that?
So first of all, we're running super accommodative. So the question is the other way around, John, is that the fact that we're still buying 120 billion of assets every single month, what we have been buying since the worst of the COVID crisis, does it make sense in this environment when demand isn't a problem, when the bond markets are wide open, etc.? And I always point to the housing market. We're still buying 40 billion of mortgages every month. The problem in the housing market is not that it needs support, it is that it's pricing out Americans. Americans can no longer afford what's happening in the housing market. Does it make sense to continuously inject liquidity into the mortgage market? It doesn't to me.